one of my more favorite indicators. In my trading, I don't use many indicators, but Bollinger Bands is one that I do use now and then because it drops right on your chart and helps us see and understand price action. And I'm a price action trader. Now, in tonight's class, I'm going to use the term security when referring to any tradable financial instrument. But I might say Bitcoin, I might say Facebook, I might say the euro, but I'm not talking about any specific asset. Okay. I'm just getting it gets very, very boring saying security, security, security. Also, I intermix the terms investing and trading. Now, since we're all here through ETX, we know that we're traders. We're trading CFDs. We know the difference between investing and trading. But again, it gets very, very boring saying trading, trading, trading. Now, the fact is, whenever I do a seminar, whenever I do a webinar, whenever I do a class, whenever I'm meeting traders face to face, first thing people seem to ask me is, should I buy today? What should I sell today? What will prices be tomorrow? Maybe next week, next year. I mean, one of the most, they're always asking me, well, where do you think Bitcoin's going to go? Is it going to hit 20,000 again? Where do you think gold's going to be? Is it going to drop below 1,000? Now, wouldn't investing be easy if we knew the answers to these seemingly simple questions? But to be honest with you, I don't have a crystal ball and I don't have a Ouija board. And anybody who tells you that they can tell you where price is going to be is full of it. Now, the fact is, we can help interpret what price is trying to tell us. But ultimately, we have to use good risk management and money management skills. Now, one of the best indicators that we can use is Bollinger Bands, because like I said earlier, it sits right over top of price as opposed to oscillators and indicators that sit below price. So when we're interpreting what Bollinger Bands is trying to help us interpret, we're looking at it with price. And indicators to me are interpreters. Price is always talking to us. We may not always be able to understand what it's saying, but sometimes an interpreter can help us with that. Now, Bollinger Bands was created by money manager and researcher John Bollinger, hence the name Bollinger Bands. Now, one of the nice things about Bollinger Bands and John Bollinger is still very active in the markets. And this allows us to get a lot of information directly from the man who developed Bollinger Bands. Now there's much discretionary theory out there. There's many people's interpretations out there. But if you really want to learn from the horse's mouth, you can go to www.bollingerbands.com and learn everything directly from Bollinger himself. Now, Bollinger Bands consists of 3 lines called the upper band and the lower band. And they use a mathematical calculation called standard deviation. Now, Bollinger Bands can be applied in all the financial markets, including equities, forex, commodities, and futures. Bollinger Bands can be used in most time frames, from very short time frames to hourly, daily, weekly, and monthly. So many people aren't aware that a lot of indicators don't work well in very short-term time frames. They give us lots of false signals. Now, the primary question that Bollinger Bands tries to answer is, are prices high or low on a relative value? By definition, price is high at the upper band and price is low at the lower band. Okay, that bit of information is incredibly valuable. It is even more powerful if combined with other tools such as other indicators, chart patterns, support and resistance for confirmation. So Bollinger Bands are a technical analysis tool. Specifically, they are a type of trading band or envelope. Trading bands and envelopes serve the same purpose. They provide relative definition of highs and lows. Now, Bollinger Bands is based on something called standard deviation. And tonight we're going to spend a little bit of time on standard deviation, but it's a very complex calculation. It was not developed for the financial market. It's a calculation that is used by statisticians for many different purposes. Now, the calculations involved are somewhat complex, and the risk of making a mistake is also high. So, also calculating by hand is very slow. This is why most statisticians rely on spreadsheets and computers to crunch these numbers. Now, we're not going to do the math to figure out the standard deviation, but you have to understand what it is. You have to understand where it comes from. So we are going to spend some time because otherwise you don't really understand these bands. So let's go over to a live screen. And this is the Euro US dollar chart. It's a 30-minute chart we're looking at, and it's my standard teaching chart. It is not there for any purpose, and we're not in analyzing the Euro US dollar tonight. We're not making any trading recommended. Every class I teach from this chart. Now, Bollinger Band starts out with a 20-period moving average. And that is the gold line that I've placed on the chart. What is a moving average? Now, you all know what moving average is, but moving averages take the noise out of the market and help us see where prices coming and going. Moving averages also help in many trading strategies. When price is above the moving average, price is usually in an uptrend. When price is in below the moving average, it's in a downtrend. Or we have what we call green-red trading. You would only consider a buy opportunity when it's above the moving average. You'd only consider a sell opportunity when it's below the moving average. This keeps you trading on the side of the trend. So we have this 20-period moving average, and this is where Bollinger Band starts. It then takes this calculation called a standard deviation, which is this complex mathematical calculation. And Bollinger Band uses a 2 standard deviation, and it drops bands above and below the moving average. So I've got them turned off. So we have the upper band and the lower band and our background. And as you can see in my indicator chart, we're using a 20-period moving average based on the close and a standard deviation of 2. Now what we get is the purple upper band and the purple lower band. The yellow shaded area is of no consequence. I've shaded it in only because it makes it easier for you to see. Also, the overall shape of the band is of no consequence. Sometimes I've seen ones that look like snakes. Sometimes I've seen ones that look like aliens from movies. The overall shape of the band doesn't tell us anything. Now, the width of the band tells us how volatile or how contrite the market is. The wider the band, the more volatile the market is. The narrower the band, the more constricted the market is. So we can see right off that here we've had lots of price movement, big price movement, and we also had a mega shift down. So what's happening is the volatility in the markets has increased because you're getting big price movements, so the bands have widened. Here the markets have pulled in and are almost trading sideways, and if you notice, the bands have contracted inward. But that's all that we get from these. Now, some people refer to the Bollinger Band width. But what we're more looking at with Bollinger Bands is the relationship between price and either the upper band or the lower band. So what I said to you earlier is that price is considered low on a relative basis when it is near the lower band, and the price is considered high when it's near the upper band. So that tells us something about the relative value of the asset at a specific point. We also, in the case of Bollinger, want to pay very close attention to the moving average line because it is a trigger for buy and sell opportunities when the assets are responding to the bands. But this is the whole part of putting a Bollinger Bands on your chart. You simply drop on the indicators and click on Bollinger Band, and this is what we dropped on your chart. I've just colorized it and changed the color so you could see it well. But this is a standard Bollinger Band. Now, there's all kinds of people out there talking about using a 2.5 standard deviation, a 1.75 standard deviation. You can do all of that, but then it's no longer Bollinger Bands. It's Billy Bob's bands or Brian's bands or Johnny's band, and the interpretations no longer apply. You have to then test it, do the calculations, not the Bollinger Band. It'll drop on your chart, but you don't know at what level is giving you false signals, good signals, bad signals, because it's no longer John Bollinger's Bollinger Band. It is Philip's Bollinger Band or Violet's Bollinger Band or Willifred's Bollinger Band. It's not John Bollinger's Bollinger Band. So we've got it on our chart now. So let's talk a little bit. Let's go back to my PowerPoint. And let's talk a little bit more about what we're looking for in Bollinger Bands. So as the name implies, Bollinger Bands are price channels or bands that are plotted above and below price. The outer Bollinger Band are based on price volatility, which means they expand when price fluctuates and trends strongly, and the bands contract during sideways consolidation and low momentum trends. The default, these Bollinger Bands are set to a 2.0 standard deviation. Now, what is this standard deviation? And I'm sorry, this is going to be an earful of technical stuff, but you need to grasp it. You don't have to do any of the calculations, but you have to understand what this line is that's up there, because otherwise you'll never make sense out of it. So standard deviation is a measure of dispersion of a set of data from its mean. Okay? That's the mathematical or scientific explanation. Now, if we remember that mean is basically the same thing as average. So we can rephrase that line. Standard deviation is a measure of the dispersion or the dispersal or the distance of the set of data from its average. Now, so a moving average is based on a set of data. To get a moving average, a 20 period moving average, you're going back 20 closes, adding them together and dividing by 20 to give it the average. And so it is the dispersion or the differences between that set of data and its average. It is calculated as the square root of variance by determining the variation between each data point relative to the mean. So each data point would be each close for that 20 period, and what is the variation to the moving average. If the data points are further from the average, there is a higher deviation within that data set. So in the simplest form, the mean is simply the average of all the data points in a given set. In investing, for example, you might want to know the mean closing price for the last 20 days, which is what? The moving average for the last 20 days or 20 periods. So this can be obtained by adding the closing prices of each session and dividing by 20. Because markets are fickle at best, traders and analysts use moving averages to adjust daily and to incorporate the most updated data. So we're using that same data. But then this mean is then put into a very difficult calculation. So standard deviation is calculated based on the mean, the distance of each data point, and the mean is squared, summed, and averaged to find the variance. Or to put it another way, variance is derived by taking the average of the data points, subtracting the average from each data point, squaring each of these results, and then taking another mean of these squares. So standard deviation is simply the square root of the variance. Got all that? Okay. Follow that? Okay, well, that's it. So Bollinger Band uses the base band, which is a middle band of a 20 period moving average. Then it uses the upper band spread above the moving average by a volatility of standard deviation and a default of 2 standard deviations. And the lower band is the middle band less the lower band. So it's the middle band or the moving average less the same volatility measure. So you take the moving average and add one volatility measure up, take it and subtract it, and you get the lower band. So moving average band, and then upper, which is 2 standard deviations, and lower, which is minus 2 standard deviations. And these are based on the dispersion of the data of all of these periods relative to the moving average. Got that? That's right. We're not going to ever go back to that again. Now, there are 3 primary uses for Bollinger Bands once you have them on your chart. We have pattern recognition, we have reversal signals, and we have trend analysis. So before we get off into the complicated ones, we're going to start off with the real easy one, pattern recognition. Now, I personally do not know anybody who uses these. I don't know anybody who's ever told me they've traded with these, so I have no idea how successful they are. Okay, but there are 2 patterns that can be found in Bollinger Bands, and we call them the M and the W. They aren't so dissimilar from a head and shoulders pattern. The fact is they take a pretty long time. They incorporate a lot of candles in order to give you this pattern and give you a trading clue. So you won't recognize them in the first, second, or third leg at all. So what we look for is what's called the N formation. Now, when we're coming off of a downtrend, we get the formation of a W. We get the opposite coming off of an uptrend. We get the formation of the M. Now, coming off of a downtrend, we won't see anything happening here. We won't see a leg. We won't even think of the pattern. This is, I mean, there's a lot of other things we'll look at, but we're too far away for anything to be decided. Just like a head and shoulders. You don't recognize head and shoulders when the first shoulder starts forming. Price is then going to move off the first bottom and move up to find a new peak. It's going to come back down. Now at this point, we might get a clue when it makes a second bottom that is pretty well equal to the first bottom. And this is called the N formation. So in this case, when we have a W, it's an upside down N. And when we have the M formation, it's a right side up N. It's at this point, when we complete the third leg, that we have some clue that we have the formation of the W. And we might want to think about getting ready to eventually make a trade. When it hits that second bottom and starts forming the last leg, we're not ready until price breaks above the moving average. When price breaks that in that last leg and breaks that moving average, we can then enter a long position with a target point equal to where that formation began to start. But this is a slow process, just like a head and shoulders. Here we have the exact opposite in the formation of the M. So again, here are 2 tops. We have the N. This is the point we would consider watching. At the break of the moving average is where we would trade. We would set our target point equal to there, and we would have had a successful trade. So if you're a pattern trader, if you happen to notice this developing, okay, like I said, I don't know anybody who's ever told me they actually made a trade based on a Bollinger Band pattern formation. But it's a well-known, well-written about pattern. Now, we highly recommend combining the Bollinger Bands with the RSI indicator. It's the perfect match. There are two types of tops that you need to know about. After the trend move, price fails to reach the outer band as the uptrend becomes weaker. And two, during consolidation, price spikes into the outer band, which gets rejected immediately. And we're going to talk about this in more detail because these are two of the critical ways or things we need to know about Bollinger Bands. So during trends, the moving average holds very accurately, and a break above the moving average is usually a meaningful signal that the sentiment in the market is shifted. Furthermore, the moving average can be used as a trade exit signal where a trader does not close his existing position unless the price has broken the moving average. When combining the Bollinger Bands with the moving average, a trader can already create a robust trading method. So we were talking about tops. So here we have an uptrend, right? Now, when price is moving up or trending upward, we would expect price to remain above the moving average, and price should do what we call riding the bands. See, the more price is moving upward, the more it rides right on the bands. Now, of course, we have price moves and pushes and eases. It comes down, but it stays above the moving average as it's making its ease, and then moves back up to continue its rally, and it stays on that outer band, but usually inside of the outer band. Now, what we see is price move up, it's up, up, up on the outer band. We see all of a sudden a candle that can't make that outer band. Then we get another candle that tries to push up and reach that outer band. It doesn't. Then we get a candle that dips down. Okay. Well, we've been now rejected by that upper band. This is telling us that this uptrend is most likely over. But our final determination will be made when it breaks the moving average. And this gives up a setup for now trading in a downtrend. So while Bollinger Bands are exceptionally helpful in determining when an asset is overshot to the upside or downside, it's important to use the bands to also set risk conditions, not just entry points. Additional risk and reward should be set based on the width of the band. So in other words, the wider the band is, the more contrite, okay, the wider the band is, the farther away you're going to have to set your stop loss. Okay. So you need to be very sure because the volatilities come back to the market. So you need to be very sure you're not going to get stopped out because of the swing of the market. What it's telling you is the market's starting to swing more, but you have to make sure that your risk reward ratio is worth making that trade at all in a more volatile market. So in contrast to most other indicators, Bollinger Bands are non-static indicators, and they change their shape based on recent price action and accurately measure momentum and volatility. Thus, we can use the Bollinger Bands to analyze the strength of the trends and to get a lot of information this way. So there are a few things you need to pay attention to when it comes to using Bollinger Bands to analyze trend strength. During strong uptrends, price should stay close to the outer band. If price pulls away from that outer band as the trend continues, it's showing fading momentum. Repeated pushes in the outer band that don't actually reach the outer band show a lack of power. A break of the moving average is often the signal that the trend is ending. So let's look at this trading chart. Now, the fact is, remember, we can only trade at the wall. And we can only trade in this direction. So knowing what Bollinger Bands did back here, back here, back here, doesn't really help us in any of our actual trading. Doesn't. But you have to, the only way you can learn and start recognizing what Bollinger Bands is trying to tell you well enough so that you'll trust it as it's showing you what is developing is by seeing how often it's happened. Okay. Like here, we're watching the moving average. So you can see how true that moving average holds. We can watch and see riding the bands. We can see the rejection of the bands and second rejection and then a move above moving average. So when we see that happening here, we can then trust our instincts. Again, here, see, we have price move up, straight up, and is riding on those, moving with the upper bands, pushing up in that upper band, gets rejected, but stays above the moving average, but then pushes back up. Here, you would have considered maybe a sell opportunity because it's telling you that uptrend is over, but you could have gotten faked out for a second there. But 3 candles later, it gets rejected, and then it goes into that strong downtrend. It rides the bands all the way down, and now it is moving away from the bands. It's telling us we can stay in this trade because we would stay in this trade till it crossed the moving average. But it's telling you that this trend has lost its legs a little bit. So we're looking for an exit point at this point. So we can tell a whole bunch of story about what's happened in the past, but here we have to trade based on our knowledge, not what already occurred. So number one, we can actually see the width of the band, so we know the volatility. We can see the position of the trade and the current candles and the next candle in relationship to the band. We can also see the relationship of that candle to the moving average. So we're getting lots of things to talk about. So remember these 5 points on the chart. Riding the bands down, rejection, riding the bands up, rejection, double rejection, riding the bands down, sideways movement. So let's interpret what they mean. First, price is in a strong downtrend and price stays close to the outer band all the time. It's a very bearish signal. The price fails to reach the outer band and then shoots up very strongly, even showing an engulfing pattern. This is a classical reversal pattern where the bearish trend strength fades. So here we go straight down, riding the band. Here we get rejected, and then we get an engulfing candle, okay, which is really a bullish engulfing candle, is telling us that that downtrend is reversing and moving the uptrend. But again, we don't consider anything until we get a break above the moving average. So then we go and we get 3 swing highs with lower highs. The first swing high reached the outer band, whereas the other 2 failed, which shows fading strength in this trend. Here, the new high touched the outer band, then gets rejected, comes back down. We try to form another high, but it can't get as high as the previous, gets rejected again, pushes back up, can't make that new high, and then breaks the moving average and moves into that significant downtrend. So as you can see, the Bollinger Bands alone can provide a lot of information about trend strength and the balance between the bulls and the bears. Now, what I want to do next is, before we go on, so I want to share a little presentation with you on how to place indicators and Bollinger Bands on your charts on the ETX Trader Pro platform. So let me pop this up, and then we'll go back and talk about some of the strategies you might want to use. And for Bollinger Bands, you just locate Bollinger Bands in the drop-down menu, click on it, and it will already set it up with the 2 standard deviations and a 20 period moving average, because that is the way it's set up. But you can customize it, like I said. Now, one of the most well-known ways of using Bollinger Bands, or one of the most well-known strategies, is very, very simple. It's so simplistic that by the time this class is over, which is just in a few minutes, you'll be able to apply it to your trading. Okay. Now remember, risk management and money management is ultimately the key to all success. Now, the Bollinger Band squeeze is a straightforward strategy that is relatively simple to implement. First, look for securities with narrowing Bollinger Bands and low bandwidth. So what we want is a Bollinger Band pattern that's got a very, very narrow width between the bands. Okay. Second, wait for the band break. And the start of a new move. An upside band break is bullish while a downside band break is bearish. Note that narrowing bands do not provide any directional clues. They simply infer that the volatility is contracting, and a chartist should be prepared for a volatility expansion, which means a directional move. So as the bands get very contracted, at some point, price is going to break out of that and is going to have more volatility. When you see price jump up with volatility, whether it expands the bands upward or downward, now you've got a clue that you can get a momentum move in there. Okay. So here we see the bands narrowing, and then price widens and the volatility widens and price jumps down. And this is the Bollinger Band squeeze. So even though the Bollinger Band squeeze is straightforward, charters should at least combine this strategy with basic chart analysis to confirm signals. So you just don't use the squeeze alone, because you also have to set risk reward, and you have to be aware of other factors. So you should have your support and resistance lines on your chart and see where price is in reaction to those support and resistance lines when you get the expansion or the breakout of the bands. And you should be looking at volume. Volume will confirm that jump in momentum. So similarly, a break below, for example, a break above resistance can be used to confirm a break above the upper band. Similarly, a break below support can be used to confirm a break below the lower band. Unconfirmed band breaks are subject to failure. So because the Bollinger Band squeeze does not provide any directional clues, chartists must use other aspects of technical analysis to anticipate or confirm a directional break. In addition to basic chart analysis, chartists can also apply complementary indicators to look for signs of buying and selling pressure within the consolidation. Momentum oscillators and moving averages are of very little value during a consolidation period, because these indicators simply flatten along with price action. Instead, charters should consider using volume-based indicators. Signs of accumulation increases the chance of an upside break, while signs of distribution increase the chances of a downside break. So be careful. So as you can see, the Bollinger Bands are a multifaceted trading indicator that can provide you with lots of information about trends, buy and sell balances, and about potential trend shifts. Together with the moving average and RSI, Bollinger Bands make for a great foundation to any trading strategy. So thank you very much for joining us tonight. Try watching Bollinger Bands on your charts, put them on, see how they react. They're an easy to use indicator. And like I said, because they sit over price, you're constantly looking at price action, interpreting price action in relationship to the bands. So have a great night. Thank you for being part of ETX family. And once again, we'll see you on Thursday. Bye now.